Imagine having so much money that you could buy Apple twice, and you'd still have some left over. Well, Warren Buffett basically has that in cash right now. $382 billion sitting idle. Not invested, not in stocks, just waiting. And the question every investor should be asking is, why? Have you ever stopped to think about what someone like Warren Buffett, a person who made $100 billion investing in the stock market, would do with $382 billion in cash? He's not the type of guy who leaves money unused by accident. Every move is calculated. Every decision has a purpose. In this video, we're going to break down exactly what Buffett is doing, why he's doing it, and more importantly, what it means for you as an investor. Because believe it or not, Buffett's lessons aren't just for billionaires. They're for anyone who wants to protect their wealth in uncertain times. So let's start with the story that changed everything. This is a financial education channel. Analysis based on public data. SEC, IMF, Federal Reserve, and academic sources. Educational content only, not investment advice. To understand what Buffett is doing now, we need to go back in time. Warren Buffett is not new to crises. He has lived through many of them. In 2008, when the entire world was in panic, banks collapsing, people losing homes, the market dropping 50%, Buffett did something very few were brave enough to do. He bought. While everyone was selling, he was buying. And what happened? He made billions. But here's the secret people don't talk about. Buffett could only do that because he had cash, a lot of cash. He had liquidity to act when opportunity appeared. Now, in 2025, he has accumulated $382 billion in cash. That's 2.7 times more than he had in 2020. It's the largest cash stockpile in the 60-year history of Berkshire Hathaway. Let me put this in perspective for you. $382 billion is more money than the entire GDP of 180 countries. It's more than the U.S. defense budget. It's more than the market value of 99% of companies in the world. And all of this is in cash, waiting. So you might be thinking, but why isn't he investing? Why leave that money idle? Great question. And the answer is simpler and more revealing than you might think. Buffett is not pessimistic by nature. He's pragmatic. And when someone pragmatic like him builds up cash at this level, it's because he sees something most people don't see. Or more accurately, he doesn't see something he should be seeing, cheap opportunities. Let me explain what that means. Let's look at the numbers. And I promise to make this simple. Berkshire Hathaway has been a net seller, meaning it sold more stocks than it bought, for 12 consecutive quarters. 12 quarters in a row. It has never happened before. What did Buffett sell? Mainly Apple. He reduced his position from 906 million shares to around 300 million. That alone generated roughly $50 billion in cash in 2025. Now, here's the question you should be asking. Why sell Apple? Apple is one of the best companies in the world. Great products, strong brand, rising profits. The answer is in one word: price. In 2025, tech stocks, especially Apple, reached levels Buffett considers too expensive. The tech sector's PE ratio is at 2.5x. Historically, the average is 1.6x. That means you are paying 56% more for each dollar of profit. Buffett has a simple rule. He buys when things are cheap and sells when things are expensive. Sounds obvious, right? But most people do the opposite. They buy when prices are high because everyone else is buying, and they sell when prices are low because everyone is panicking. Buffett is not most people. Another important point, Buffett isn't just selling. He's also generating cash through Berkshire's operating businesses. Insurance, energy, railroads, all of them generate profit. In 2025, operating income reached $11.2 billion. That's money coming in every quarter. So when you combine selling expensive stocks, strong operating income, and a lack of major acquisitions, you get a simple formula: cash accumulation. But here's the cliffhanger. Why isn't he buying anything? Where are the big acquisitions? Where are the investments? The answer lies in what comes next. Here is something most people miss. Buffett doesn't talk much about market cycles. He's not alarmist. He doesn't go on podcasts saying, "The world is ending." He's quiet, pragmatic. But when you look at his actions, not his words, but his actions, you see a different story. In 2025, Buffett said, "Despite what some commentators see as an extraordinary cash position at Berkshire, the vast majority of our money remains in equities." Translation: yes, we have a lot of cash, but we still believe in stocks. We still believe in the market. But we're not buying now. We're waiting for more favorable entry points. Now, there's another guy who's being more vocal about what's coming. Ray Dalio. Dalio is one of the biggest investors in the world. He founded Bridgewater Associates, a fund managing hundreds of billions. And in 2025, Dalio is saying something you should be paying attention to. He said, "We are heading into a period of significant economic and political uncertainty." Dalio is talking about structural imbalances in the system, about potential shifts in the geopolitical and economic landscape caused by unsustainable debt levels and rising inequality. U.S. national debt is at $37 trillion. Let me put that in perspective. That's $110,000 per person, for every man, woman, and child, and it grows every year. Dalio compares the current structural challenges to historical periods of major economic transition. Now, here's the connection when you combine Buffett's measured positioning, accumulating cash, with Dalio's analysis of structural risks. You see a pattern. A pattern that says the biggest investors in the world are preparing for something. But what exactly? Let's explore. There's one sector growing extremely fast in 2025, artificial intelligence. Everyone is talking about AI. Everyone is investing in AI. Everyone is buying AI stocks. And here's the problem. Not all of these companies deserve the prices they're getting. Buffett knows this. He saw the dot-com bubble in the 90s. He saw the housing bubble in 2008, and he recognizes when market sentiment may be overextending valuations. One of the key moves Buffett made in 2025 was drastically reducing his position in Apple. Why? Because Apple is a hardware company, and in a world where AI becomes commoditized, pure hardware is not as valuable. But here's the interesting part. Buffett didn't leave tech entirely. He bought $4.3 billion in Alphabet. Why Alphabet and not Apple? Because Alphabet has something Apple doesn't: data, billions of data points. And in an AI-driven world, data is gold. That's selectivity. That's pragmatism. Now, the tech sector is consuming $200 billion in capital investment in 2025, but returns are decreasing. You invest more and make less. This could precede sharply market corrections. And when valuations correct sharply, stock prices decline significantly. Weaker companies struggle to survive, and many investors face losses. And when that happens, who has cash? Who can buy cheap? Buffett, Dalio, the biggest investors in the world, they're waiting. What about you? Are you prepared? So you might be thinking, okay, Buffett is hoarding cash. Dalio is concerned. So what? What do I do with my money? Great question. Let me give you 3 practical lessons based on what Buffett is doing. First lesson, consider maintaining cash reserves. Buffett has 30% of his assets in cash. Many financial advisors suggest 2 approaches. Either maintain 3 to 6 months of expenses in liquid savings, or invest in treasury bonds, which yield 4% to 5% per year and are extremely safe. Why? Because when opportunities emerge, and they emerge during periods of market volatility, you need to be ready. Second lesson, diversify. Buffett is not all in on Apple. He owns dozens of companies, insurance, energy, railroads, banks. When one sector struggles, others balance it out. Third lesson, Don't follow the crowd. When everyone is buying tech in 2025, Buffett is selling. When everyone panics, Buffett stays calm. When everyone is euphoric, Buffett is cautious. That's not pessimism. It's pragmatism. So back to the original question. Is Warren Buffett positioning for a market correction? The honest answer is he's preparing for one. Not because he knows exactly when it will happen. Nobody does. But because he recognizes the signs: unsustainable debt, inflated valuations, AI bubble, political polarization. And when you see these signs, you do what Buffett does. You prepare. Now, here's the payoff you are waiting for. What does this mean for you? It means you don't have to be a billionaire to learn from Buffett. You don't need $382 billion to apply these principles. You can start today with your money, with your portfolio. Maintain adequate cash reserves. Diversify strategically. Make independent decisions based on valuations and fundamentals, not market sentiment. These are the lessons the world's biggest investors are applying right now, and you can apply them too. Now I want to hear your opinion. Do you think Buffett is right to hoard cash? Or do you think he should be investing more? Leave a comment below. If you found this video useful, give it a like and subscribe to the channel. New videos every week. But here's something you should know. Buffett is not the only one preparing. Ray Dalio uses a specific indicator to assess systemic risks and economic cycles, an indicator that reveals important insights about current conditions in 2025. And in the next video, I'm going to show you exactly what that indicator is and how you can use it to protect your wealth. Don't miss it. This content is for educational purposes only and does not constitute investment advice. The information presented is based on public data and expert analysis, but markets are unpredictable. Consult qualified financial professionals before making decisions. Your wealth is your responsibility.